All right, welcome back to the Financial Shepherd Happy Hour. I'm Joshua Casey Garland, certified financial planning professional, owner of Shepherd Wealth Management. Cheers to all of you. This is Ezra, video editing genius. Welcome back to our show on Fridays. We do this every Friday, or try to do it almost every Friday, right around 4:15, just to kind of wrap up what happened this week in the markets. Why did it happen? What can we look forward to next week? And before we get into all of that, any updates for you this weekend, Ez? I know we got Thanksgiving kind of coming up here pretty soon. But,
man, I don't really want to think about that. But no updates for me. I mean, same as always, a pretty boring life working.
Well, I'm glad that you're working. Couldn't do this show without you, so certainly appreciate what you do. It was a hell of a week. I got to be honest, this was the best week so far of this year, and it had everything to do with the inflation data report that we got just a couple of days ago. So the October core CPI inflation came in at positive 0.3%. That was much lower than the estimates of 0.5%. So basically what happened is from the last inflation reporting that we got the prior month, we were at 8.2%. This month, we are now down to 7.7%. So still high, right? I don't think anybody would argue that that's not a high number. It definitely is. It's not anywhere close to the 2%, inflation that the Fed would like to see on an ongoing basis. However, it's going in the right direction.
Yeah,
right. You have to start
in the right direction. See if we can.
Yeah, you have to start somewhere. And today, or this past inflation report, was our starting point to finally get some tangible evidence that inflation is in fact going in the right direction that the Federal Reserve is trying to push it towards. Now, some of those numbers that make up the CPI calculation, I've been saying this for months on end now. Over 50% of the core CPI data points have been falling like a rock. It's just some of the bigger weighting ones, like owner equivalent rent, finally slowed down a little bit. It showed a positive 0.6%. The preceding couple months in August and September, it was showing positive 0.7 and 0.8%. That's 23% of the CPI calculation just in that one number right there. And I think most people would agree, if you drive around town in your neighborhoods or wherever you live, you can see that home prices are coming down, because you're seeing 7+% 30-year mortgage rates right now. Obviously, that's going to price a lot of people out of the market. Yeah. People are not being able to sell their homes. I know of at least 3 in this neighborhood right here where I live that have been up for sale for quite some time, and prices have been dropping repeatedly. Now, the owner's equivalent rent number coming down is meaningful. I am a landlord. I know a lot of investors, have rental properties and so forth, and we only do a lease agreement once a year, right? So that's a big reason why this number isn't actually showing up in the inflation calculations the way that it actually is in the real economy here. So that's something that I'm very excited about. I think that that'll persist in the upcoming inflation report that we're going to get at the beginning part of December, literally right the day before the Fed has its meeting and makes an announcement for the next CPI. So we're going to have a lot to talk about, of course.
That pesky Fed.
As we get into December. Some other important statistics as it relates to inflation, since that's really what rallied the market this week. And I just wanted to share with everyone. I mentioned this in a previous happy hour. So if you haven't been paying attention, you're welcome. I'm going to bring this information back to you. Used cars.
Great movie.
It is. Used cars, big part of CPI calculation, is still showing a positive 2% year over year. However, the Mayhem index, which is the index that we use, or what economists use and analysts use to kind of get a real idea or a real sense of what used car prices are doing at this very moment in time, well, the Mayhem index is actually down 10% year over year. So that's that lag effect that I've talked about in previous episodes. The Feds raise rates faster than they ever have in human history. It actually takes some time in a very complex global economy and a very complex economy right here in the United States, where that to actually start to show up in economic data, specifically the calculation for inflation. So that'll actually match up at some point. It might take a couple more CPI prints for that to happen. But the point is, these big drivers of the calculation for inflation are in fact coming down. So that's obviously a really good thing for the market. You saw that here this week. S&P 500 was up 5.5% for the week.
I just got to say, that's my favorite index.
Is it?
Yeah, I love it.
It's a good one. The NASDAQ, which is obviously the tech sector, that was positive almost 8% for the week. So that's awesome. That's been the heaviest beat down index.
Oh, they've been taking on the keister over there in the NASDAQ.
All,
It's crazy.
all year long. And the Dow Jones, which had an excellent month, was actually up 4% for the week as well for the industrial stocks. So some of the bears have been saying the Fed does not want equity markets to go up and rally like this. And this is, in my opinion, oversimplistic. The Fed was in a hurry to slow things down in 2022. That's why they've ratcheted rates, 4 straight times at 75 basis points a clip. And they also did a 25 in the early part of this year, followed by a 50. However, this is an interesting point. The Fed was obviously in a hurry to slow things down. The price to earnings ratio averages 19 times forward earnings when the 10-year Treasury note is between 3.5% and 5.5%, which is exactly where we're at right now. With that being said, since 1871, those that have been arguing that PE ratios of the S&P 500 should be 5 times or less are really just ignoring history. So there's a whole bunch of people, famously on CNBC, I watch it regularly. It's in my office playing all day long. I have it on my phone. I can catch it live. A lot of people have been saying earnings multiples need to come down. That might be true for some specific companies, maybe some specific sectors of the S&P 500. But for those that are calling for price to earnings ratio of the S&P at 15 or lower, just flat out ignoring history. This is data going back to 1871, right? So we should see a rally in equities, not just based on the inflation numbers or the things that make up the inflation calculations coming down, but just history overall has to say when the 10 years in this range of 3.5 to 5.5, we should see a multiple right around 19 to 20, which means we should see a pretty nice rally here coming into year end. Obviously, that'll run up against the next inflation report, which is going to happen in December, right? So we have an inflation report. Very next day, the Fed will make an announcement for rates. So more to come on that. Definitely want to make sure you're catching our show. This is something we talk about on a regular basis. And we do it a little differently than what the news outlets will do. We'll not only tell you what's happening and why it's happening the way that it is right now, but we'll also provide some historical context around that so you can actually plan accordingly for the future, which is what the news outlets do not do such a great job of doing. But that's not really their job.
No.
Right? That's not their job. So that's why you have us here to give you the real information as well as the historical data that goes along with that.
Terrifying, confused. That's the job of the news.
Well, of course, you've seen that in the political debates, which this isn't a political show. However, we do have gridlock in Washington, which is, in fact, historically a very good thing for stocks.
Very good thing.
So between the gridlock that we have in Washington, as well as what's happened with inflation reports, is a major reason why we're seeing the type of results we're seeing. And I've kind of talked about this all year long. So if you've been following us all year long, this is something that we've really been preparing for our clients. We had to overweight energy. We had to overweight healthcare. We still are overweight in those spaces, but that's going to change here relatively quickly, because if all of these things line up the way that they have so far here recently, and it continues into December, you can bet your bottom dollar that tech sector is probably going to continue the type of rally that you've seen here this past week. And we want to be in a position to take advantage of that. So rebalancing out of the sectors that have worked well all year into something that is not should be a pretty nice result 12 months later on down the line. By the way, since World War II, there's been 18 midterm elections, and 18 out of 18 times the market was positive 12 months later. So
get ready, saddle up.
For all the bears out there, you guys can chew on that on your
while you're hibernating.
Now, last thing here, in 1982, all right, so we're going back to 1982, following the final low in August of 1982, which, again, I'm using 1982 because the early 80s, 80, 81, 82, is the last time we saw 40-year high inflation. Well, that's the last time we saw inflation like this. Now, 40 years later, we're comparing the two time frames.
Okay? Other than us being born around that time, it was a horrible time. Horrible.
That's right.
Not much good else happened.
The 80s movies were pretty sweet, though, I got to say.
Later 80s, yeah. Mid 80s.
Absolutely. But 1982, following the final low, so August of 1982, we hit a final low in the S&P 500. We reached a new all-time high within 4 months. All right? That erased the entire 27-month bear market. So we got, in 4 months from the low in August of 1982, it only took 4 months to erase over 2 years worth of a bear market. I'm telling you all this right now because what you just saw this week from a rally perspective, if this persists, meaning that inflation's still coming and trending downwards, and the Fed is going to increase rates maybe 50 basis points instead of 75, or God forbid they do just 25 basis points.
How about none?
Or none. You're right. I don't even know if they really need to do anymore, but let's just give them give what the futures market is pricing in right now is a 50 basis point hike in the month of December. So let's just assume that that happens. That's probably about the peak of the Fed increasing interest rates, specifically if they get another CPI inflation print that is continuously going down. So this is probably, in our view, if this persists, not the last type of rally that you're going to see, specifically in the tech sector. And that was evident in 1982. It truly was a vertical rally. Now, basically wiping away 27 months worth of losses in just 4 months. I'm having some anticipation of that for our clients here, and we're going to respond accordingly by simply rebalancing, again, out of things that have worked well into something that has not worked that well so far this year, which is tech, which, by the way, is the largest sector of the S&P 500. It led the way down. You should expect it to lead the way out of this bear market. I mean, quite frankly, if bull markets on average last 3 years, which they do, and we've always had a bull market after every single bear market that we've ever had in history, then you would expect that you have to have 25% of the market participating in that rally for it to sustain itself for 3 years. So these are the things that we're doing for our clients. These are the types of information that we really are paying attention to all year long, and have tried to been planning accordingly for our clients. So hopefully that's helpful. Check out our website if you're looking for previous episodes, not just the happy hour episodes that we do on about every Friday, but it'll also take you to our YouTube page where you can catch our full-blown podcasts, typically around 40 to 50 minutes long. And it'll also give you a whole bunch of background information about myself, my company, and what we're here to do from a investment and retirement planning standpoint for our clients. Last but not least, a small teaser. There's about to be a whole bunch of really exciting news that I'll have to share with you relating to Shepherd Wealth Management's business and the future that we're going towards. So I'm very excited to share that with you all in the coming weeks. Certainly we'll be making a pretty big announcement, I think, before the end of the year. So stay tuned to that. And if you do have questions...
I'm pregnant. Sorry.
Sorry, we got that out. But if you do have questions, not about that, but
Gender
about...
reveal. Come on.
about any of the things that we've talked about here today, or any other things that you might have, just your own, questions about your own situation, give us a call, send us a text message, 513-630-2664. And again, if you go to shepherdwm.com, you'll be able to get a hold of us either via email or with that same contact information, as well as check out all the things that we're doing on social media, as well as YouTube. So,
and for anybody who does go back to the previous episodes of the podcast or the happy hour, as you're looking through all of the, any of the points that Joshua brings up in this episode or other ones, you can see tons and tons of lectures that he gives about the historical precedents and why, we've been kind of calling for this situation to happen. He has been calling, not me, all year. So if you're looking through those episodes and you have a question, please leave one in the comments. We'll definitely see it. And that way you can have a specific response to some of the data that Joshua brings up. So feel free to leave a question there and we'll get to it as soon as we're able to.
Absolutely. And last but not least, happy Veterans Day for all those that are serving and have served. We certainly appreciate the sacrifice that you've made. And, we wouldn't be here as a country, as a free nation without that. So we certainly appreciate all of those that are serving and have served. With that, this is probably the last time you'll see me in a short sleeve shirt for the rest of 2022.
I don't know how you're doing it today, dog.
But we certainly look forward to doing this again. Almost every Friday around 4:15. The only time we can't do it is when Ez is out of town and I can't work the technology, and/or we're just tied up doing something with clients or prospects. So hope you all have a wonderful weekend. Enjoy Veterans Day, and God bless. Hope you guys join us again next Friday. Cheers.
Cheers.